Support for Carolina Business Review made possible by Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services, with more than 300 operations in 35 countries, headquartered in Hartsville since 1899. And by Business North Carolina Magazine. There's a place for those who subscribe to the theory that business doesn't have to be boring.
Well, there are encouraging signs that unemployment may indeed be trending lower. That's good news. And many businesses report at least incremental increases in revenue growth. But barriers to the go-go growth earlier this century are still very real. Access to capital, debt levels, and now a more recent phenomenon, increasing costs of compliance, also known as just plain more regulation. Welcome again to the most widely watched source for Carolina business and public policy. I am Chris William, and we begin with our panel in just a moment. And later on, the chief economist for one of America's largest home loan guarantors, Frank Nothaft from Freddie Mac.
Major funding for Carolina Business Review provided by Grant Thornton, an international accounting, tax, and business advisory organization dedicated to serving middle-market companies. Grant Thornton, a passion for the business of accounting. And by Novant HEALTH, a not-for-profit group of hospitals and physician clinics, ranked as one of our nation's 10 best healthcare systems, caring for patients and communities in North and South Carolina. Major funding also by King & Spalding, an international law firm with over 800 lawyers in 13 offices worldwide, providing legal services to clients in the Carolinas and throughout the world. For more information, visit www.kslaw.com. This edition of Carolina Business Review was recorded March 30th, 2011. On this week's program, Pete Anderson of Anderson Terpening, PLLC. Rebecca Gunnlaugsson of the South Carolina Department of Commerce, and special guest Frank Nothaft, chief economist of Freddie Mac. Now, Chris William.
Hello, welcome again to our program, and happy spring, guys. Thanks for being here. You know, Pete, let's start with you because, you know, we've all kind of rolled our eyes, and not just at banks, or not just at financial services firms, or not just at law firms, or you know, the more regulated firms, but this whole notion that there is a, much like Sarbanes-Oxley was punitive, what many people thought was punitive to the balance sheet of corporations, now we've got a whole new level of compliance. First of all, is that a reality, not just an impression? And second of all, what does that do to the small, the service firms, the $500,000 or the $5 million firms out there?
Well, Chris, there's no doubt that whenever you have any actual or perceived crises publicly, the first response, and we've seen this cyclically over the last 30 years, the first response is Congress feels obligated to do something. And sometimes it takes 6 months to get the new law passed. Sometimes it takes a matter of weeks. I much prefer the former, but recently these crises demand kind of quicker attention. And with that speed and desire to do something, right, to instill in the public that Congress needs to give the impression that we're on it, they don't always get it right. And they don't really bring in enough of the actual decision makers in each of these industries, banking, healthcare, securities. Whatever the crisis was, there's this perception that there's no trust left. Therefore, if the industry didn't keep its skirts clean, then it's got to be done externally. I'm always a proponent of industries to say
self-policing,
self-police, self-governance. You'll get it right. It'll be more cost-effective, and it won't be externally imposed. And whenever you have that combination of hyper aggressive regulation, there's always ineffectiveness and gross kind of overspending.
Well, and let me ask you, not to cherry pick the new regs and whatever that is, but specifically since it's so large and overarching, this Bureau of Consumer Financial Protection, you know, the intent there is to keep banks from taking advantage of depositors and investors. Very noble. Does an agency like that, is it overthought? Is it effective? Is it going in the right direction?
I think, again, as you point out, the motivation is laudable, right? Who would be opposed to kind of, you know, protecting the consumers? It's all in the implementation. The devil's in the details. I think it's too early to say where in that pendulum of overregulation, underregulation we're certainly heading in the overregulation. There's going to be kind of mid-course adjustments over time, and we'll just have to see how it plays out. But that's a common trend in every industry.
Sorry, Pete, sorry to interrupt you. Rebecca, let me bring you into this from the statistical and the empirical side. When you look at not just trends in South Carolina or how the economy's doing or how business is kind of unfolding, but this whole idea that compliance and this new batch of regulation on top of existing regulation and what we're compelled to do as business people, has that been a wet blanket on some of the growth that's desperately needed?
Well, I think as Pete just pointed out, we don't know a lot of what's going to happen. But as each layer of regulation has come on in the past, the first thing that businesses face is uncertainty. We don't know what's going to happen, and uncertainty in general depresses investment and depresses their ability to act, to hire new employees, to grow. And once the uncertainty passes, then they can formulate a plan. And part of that plan is how to navigate the regulations. And the regulations and the taxes, the additional business costs typically change the market equilibrium, change the fundamentals, change the way economic resources are allocated. And that's the major effect that it has in terms of the efficiency of the markets operating.
You know, as I sit here and listen to you all, I think also that the new healthcare reform, and we can't even say that it's new anymore, it's now a year old. That was a lot of uncertainty, to use your term, Rebecca. Do you feel like there's still a lot of businesses out there that are not quite as vocal about it, but are still uncertain about it? Or are businesses starting to embrace that, yeah, healthcare is going to be different, probably more expensive, but certainly different?
Oh, well, yeah, I think there's still a lot of uncertainty. I think there's a lot of uncertainty in Washington about whether or not to repeal it or to keep it. And I think businesses are waiting. But as in terms of your question, do businesses anticipate that healthcare is going to be more costly? Most certainly they do. And the way the government works out the healthcare bill, whether it's more costly to keep health care insurance for employees or to pass it on and let the federal government maintain it, that is yet to be seen.
Yeah, Pete.
Well, I would definitely agree. It's ironic that the statutes are often kind of crafted quickly and implemented slowly.
Yeah.
I'd prefer the reverse, where there's more thought given in the congressional committee level. Take the time, get the right infrastructure legally and regulatorily, and then go ahead and pass it.
Let me give you just a quick word, a final word, at least on the cost of compliance and this new. Do you expect that regulatory compliance, adhering to regulations, is going to get harder before it gets easier, or is it about as bad as it's going to get right now?
It depends upon the number of upcoming crises that may come up. At least with the new legislation that's been passed in a variety of industries. As Rebecca points out, the uncertainty is expensive, and you'll always find this learning curve that has to be climbed. And not only is that costly in terms of the implementation, but costly also if companies get it wrong. And then you'll see a wave of enforcement, and then eventually it'll reach an equilibrium, and hopefully there'll be self-governance and mid-course corrections.
Okay. Rebecca, unemployment seems to be trending lower. Is that an anomaly or is that a trend?
Well, I think I'm going to say it's both. But for the past 7 months, since in the middle of 2010, we saw very slow, modest, stable growth in employment in South Carolina. And I say modest, but relative to the rest of the nation, it was actually quite good. Until February came along, and then suddenly we had all of these incredible economic indicators. We added 22,000 jobs. We saw an uptick in construction employment finally. We saw an uptick in residential building permits. We saw a dramatic decrease in first-time jobless claims. So we're looking at those cautiously. We don't necessarily know that it's putting us onto a higher growth trajectory, but I think we were already on a growth trajectory, a slow, steady one. Again, the numbers, many of them were preliminary. It'll take a couple of periods before we can see just how sustainable that is.
And when you talk specifically about construction in there,
yes,
and housing, in which we're going to talk about with our guest in a second here, is it finding a bottom, or is there something there that's just going to keep it from going lower sooner?
Yeah, well, again, something that we're still looking at. While our residential building permits were finally ticking up, they are still down over the previous year. And February, in general, had a low, sales numbers throughout the state. So we're getting sort of mixed signals there, and again, something we're looking at going forward.
And I don't want to press you on this too much, but I know you can't take this stuff in a vacuum and make a determination. But when you look at the residential building permits, I mean that is a bit surprising. Where do you think that comes from?
Well, I think we're coming into the construction seasons, and a lot of these are seasonal when you look at construction employment. And residential building permits. But we had such a long run of continual declines in both of those areas that any uptick at this point is something that we're taking notice of. Yeah.
Sure. Okay. Well, that's going to be the last word. Stay with us. And this whole idea of construction and residential and commercial real estate, we're going to continue this not just with our guests, but also next week on this program. In fact, we're going to have a whole panel, and we're going to look at where we are and why real estate has not come back seemingly as strong as some of the other sectors in the industrial sectors in this economy. So next week on this program, Ed Fritsch is the Chief Executive Officer of Triangle-based Highwoods Properties. Ed will be back on this program. Along with Ed, Dr. John Sylvia, Wells Fargo Chief Economist, and then a regional real estate, residential real estate firm out of Charlotte region is Patty Hendricks will be on that program as well. In 1970, by act of Congress, the U.S. put in place an agency to provide liquidity and the ability for many Americans to buy their own home. In effect, what the government was doing was guaranteeing to banks credible citizens who wanted to own their own home. Well, it seemed to work pretty well for about 3 decades or so, and then came 2008. Now, the fate of Freddie Mac and other government-sponsored agencies, or GSAs in the vernacular, is in question. As of September 2008, Freddie Mac is operating under a conservatorship of the Federal Housing Finance Agency. Joining us now is the chief economist from Freddie Mac, Dr. Frank Nothaft. Frank, welcome to the program. Good to have you here.
Thanks for having me, Chris.
Let's just say here at the top of the dialogue that we will not be asking you, and no, you can't by law talk about the conservatorship or how the corporation is structured right now, so we will not do that. But Frank, I would like to start with this whole notion that if you were in a room, if you got to be one of those folks in a room and given a blank sheet of paper and said, come back with the best idea that you have to set up a financing agency for this government to sponsor or run or endorse or put in place so average Americans can buy homes, what would that look like?
Well, clearly what we had in the mid part of the last decade was something that was really not sustainable because we had very loose underwriting. And what's important to have is good quality underwriting going forward. We need to make sure that borrowers who apply for a mortgage have the financial resources to make those payments. Nobody wins if a homeowner has to be thrown out of their home through foreclosure. So what's really, really critical is that the housing finance system provides the credit that Americans need in order to finance their homes, but in a sustainable fashion, so that homeowners who obtain a mortgage can stay homeowners on longer term. So that means having the cash reserves, having some down payment, and having a payment that's affordable to them.
So this is, when you say sustainable, this really goes back to, page 1, step 1, make sure the borrower is creditworthy.
Absolutely.
Is that what we're talking about?
Absolutely. It's going back to traditional basics of underwriting, looking at the value of the collateral, the capacity to pay, and the overall creditworthiness of the borrower. Those are the three fundamental C's of underwriting in the home mortgage market.
Now, we're not going to indict or even intend to indict any sitting office politicians, but there was a CEO, the former CEO of RBC Bank, Scott Custer, was on this program 2 weeks ago, and Scott sat here and said that he remembers at the beginning of this past, I have to remember now, beginning of the millennium, he sat in a room with Representative Barney Frank and other members of Congress, and they were pushing banks to make these loans. So when you feel the heat of political pressure, and it can be withering, and not just in Washington, but the State House in Raleigh, in Columbia, when you feel that withering heat, how do you stick to your guns and say, yeah, but we can't forget about this one principle?
Well, and it can be a lot of pressure. It can be a lot of pressure, but it's important to really stick to good quality underwriting. And I think it's the real loose, weak underwriting standards that occurred in the mid part of the last decade that really contributed to the problems that we have today. So we just have to go back to traditional underwriting, to traditional loan products, because they have been well tested over time and they have performed well.
Question?
My biggest question was, as a non-economist, what was the difficulty, in your opinion, on the ability to predict where we were heading? I think a lot of people ask, kind of, how did we miss it, and how do we prevent it from happening again? Those are the two burning questions that, if you have the answer, you might be up for a Nobel Prize. But I thought I'd give you the opportunity here first. So.
Well, you know, it's always hard to know that you're in a bubble when you're going through it, because there are always other folks out there who say, well, this time is different. We've learned new things. We have a paradigm shift. We have new instruments in the marketplace. We have new financial tools. So this time is different. Turns out this time is not different. This time is very much like other experiences we've had with financial crises and asset bubbles.
Do you think the banks understand that? You get a sense that all the banks, I know they'll say they understand it, but when offline or in cocktail parties or do you get the sense that the banks really understand that it's about underwriting now, again?
I do get that sense, and we've certainly seen much tighter underwriting requirements in the marketplace today. Maybe too tight right now, but we have seen a tightening of the underwriting quality. Now, will they know it the next time we're in a frothy market? That's hard to say. Everyone says they understand it today, and it's having that very common sense approach next time when we get into an overheated market. That's the big question.
Rebecca?
Well, for decades, the federal government has really focused on home ownership, and with the housing collapse and the ensuing recession, there's been a lot more dialogue about whether or not owning a home is actually what everyone wants or even needs. And so I'm curious if there are any new sorts of policy or dialogue taking place regarding I guess the funding of affordable rental units, particularly in more urban or populous areas.
I think Americans still have strong aspirations toward home ownership, but I think there's also much greater understanding and acceptance of the transition from renting to home ownership. So renting is a very initial step for young households, and I think that's very important. It's important we have a good quality rental housing stock because it provides that transition, that step into the housing market, and then ultimately into home ownership at a later point in life. What's important is that the families have the financial wherewithal. They have the savings, they have the cash reserves, they can make the down payment so that they can be successful once they decide to make that leap into home ownership, that they can sustain it over time.
It's kind of a follow-up on that. Frank, in conversations that I had recently with some members of the Federal Reserve Bank, the question was asked, what is the difference now between commercial real estate and residential real estate? Why is it that commercial real estate seems to be ahead in a recovery standpoint from residential real estate? And the Fed unofficially, if that's possible, the Fed made mention that it's more likely because commercial real estate was able to free fall and wasn't propped up by stimulus or artificial type of spending and support that residential real estate had. How do you come down on that issue?
Well, I think looking at the residential market, there's a difference between single-family ownership and the rental markets. And the rental markets have come back. We've actually seen improvements in many areas around the country in terms of the overall performance of the rental market. Here in the Carolinas, we've seen vacancy rates move lower over the past year. We've seen rents stabilize or even gradually move a little bit higher, too. So I think the rental market has gotten a lot more healthy here in the Carolina area. There's still a lot of weakness and softness in the single-family homeowner space. So I think there's a dichotomy there. some of the bounce back in the commercial sector, I think, has to also be due to the fact that cap rates have come in. They've come down relative to where they had been. They had spiked out significantly, and that impacted property values substantially. The drop in commercial property values was actually much more quick and substantial than in the single-family space, but likewise, we've seen a bigger comeback.
Okay. Well, one question also, what do you think is prompting kind of these legislative or administrative proposals about the future of Freddie and Fannie? What's kind of what's behind that? What's driving that?
I think to try to reduce or eliminate some of the uncertainty of the future. What will be the future of the housing finance delivery system in America? And so that's prompted a lot of dialogue, a lot of very good dialogue. It's prompted hearings in Congress. It's prompted legislators to think about how to draft and structure bills to try to address some of these issues. And I think some of it is really try to reduce and mitigate some of that uncertainty about where we're headed for the housing finance system here in America.
Do you have any predictions?
I don't have any predictions at the moment. We'll have to see how it goes.
Smart man. Rebecca.
Yeah, with the latest round of weak housing numbers, there has been some chatter about housing being in or headed for a double-dip recession, and one of the major causes being the first-time home buyers credit. And I'm curious what effect you think that is having now and will have into the future on the housing market.
I think the first-time homebuyer tax credit that we had in place at the beginning of last year was actually very important in helping to stabilize the housing market and bring home buyers into the marketplace and prop up home sales. Now, looking forward, what I see right now is that home buyer affordability is at a very, very high level. So that provides a good foundation for supporting housing demand going forward. It started off a little bit soft at the beginning of this year. Oftentimes in winter months, housing demand tends to be soft, and we probably have a fair amount of supply that came onto the market over the winter through some of the foreclosures and the excess inventory that we've had in some markets. I do think going forward, as we get further into 2011, we'll see that the housing market will actually do pretty well because home buyer affordability is so high. Our forecast is actually for home sales to be up in calendar 2011 about 5% or so compared to calendar 2010.
So broadly, you would say we're pretty close to a bottom in this housing recession.
I think so in terms of overall demand. Now, in terms of house prices, I think in these national house price indices, we'll see that house prices will probably recede a little bit further, but they will bottom out over the course of 2011. Whether it's the first half, second half of 2011, it's a little unclear, but I do think we'll see the bottoming out of these national house price indices in 2011 with some very modest gradual improvement in 2012.
Now, we've got about a minute left, Frank. I want to come back to this whole idea of, fueling the home prices is going to be obviously lending and lending rates. And after 2008 and the equity markets went through the gyrations they did, just very quickly, where do you think interest rates are going to go within the next 24 to 36 months? Higher, stay the same, or what?
I think for the bulk of 2011, we'll see 30-year fixed-rate mortgage rates on single-family stay in a fairly narrow band of between 4.75% and 5.25%. We're more in the lower half of that range here at the start of this year. We'll be at the higher end of that range in the second half of the year. And if the economic recovery really gathers steam, we may actually see them get a little bit closer to 5.5% by the end of the year. So the trend is for a little bit of an uptick. Thank
you, Frank. And thanks for putting yourself out there. And good luck at Freddie Mac. We'll watch as it unfolds there. But good to have you in the Carolinas.
Thanks for having me, Chris.
Thank you very much. Rebecca, always nice to have you. And our best to your new chief down there, Bobby Hitt.
Thank you.
And thank you as well, Pete. Always good to have you.
My pleasure, Chris. Thank you.
Until next week, I'm Chris Woody, and we hope your business is good. Good night.
Major funding for Carolina Business Review provided by Grant Thornton, an international accounting, tax, and business advisory organization dedicated to serving middle market companies. Grant Thornton, a passion for the business of accounting. And by Novant HEALTH, a not-for-profit group of hospitals and physician clinics, ranked as one of our nation's 10 best healthcare systems, caring for patients and communities in North and South Carolina. Major funding also by King & Spalding, an international law firm with over 800 lawyers in 13 offices worldwide, providing legal services to clients in the Carolinas and throughout the world. For more information, visit www.kslaw.com. Additional funding provided by Business North Carolina Magazine. There's a place for those who subscribe to the theory that business doesn't have to be boring. And by Sunoco, a global manufacturer of consumer and industrial packaging products and provider of packaging services, with more than 300 operations in 35 countries, headquartered in Hartsville since 1899. And by viewers like you. Thank you. Web design, media strategy, and email marketing services by CC Communications. You may write us at Carolina Business Review, 3242 Commonwealth Avenue, Charlotte, North Carolina, 28205.